You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mike Yahoo. Hey, what's up, Market Moose? Mike from The Moose on the Loose. Happy Wednesday. Yesterday, I discussed the fact that growth is not certain, but the yield is not certain as well. And then last week, we just got the most amazing dividend grower company in Canada. Amazing because it shows 53 consecutive years with a dividend increase. So Canadian Utilities, ticker CU.TO, increase its dividend once again. Okay, by 0.70%, so not even 1%, but still 53 consecutive years of increase. And I received an email or a couple of emails recently about Canadian Utilities asking if it was a good pick. What do I think about it? So there you go. Let's take a deeper look at what's going on at Canadian Utilities. So all numbers, all the information that I'm sharing with you guys today are actually found on dividendstocksrock.com. We cover with a full extension, so providing the investment thesis, the risk potential, and the dividend growth perspective on top of like dozens of graphs, 50 financial metrics. You get all the information you need to take the right decision. So I'm using this stock cards based on Canadian Utilities today to share a little bit of DSR on the Moose. So there you go. So in times of uncertainties, that could feel very good to invest in a regulated utility business. Those are known to be super stable, very solid dividend payer, especially for Canadian Utilities. So there is an attraction here. So let's understand a little bit more about what's going on at CU. So the business model, the company is divided into four segments. The first one, ADCO Energy Systems. This one is a pure play on natural gas and electricity transmission and distribution. So really, like most of the business, it's all about distributing related electricity based on natural gas and power. Mostly in Alberta, but also in other territories, especially up north in Canada. The second segment is ATCO and Power. So this one is a energy solution based around renewables. So we're talking about wind, hydro, solar power. We're talking about energy storage. We're talking about industrial water, clean fuels. So it's a lot smaller than ATCO Energy, but they do have a renewable energy segment. They also have ADCO Australia, so they develop, build, and owns and operates actually energy infrastructure assets in Australia. And finally, they have corporate and other, where you can find other smaller companies such as ADCO Energy, Rumi, which provide retail electricity and natural gas services, home maintenance, and most of it is also in Alberta. We're talking about a utility business that owns about 23 billions in assets, and the playbook for a regulated utility is quite simple. They have a territory, in this case mostly Alberta, a part of like north of Canada. They have like portion in like Puerto Rico and Australia, but they do have territories. In those territories, the regulators will tell them, well, we give you a territory large enough so you can maintain a very solid power grid, because we want to have stability here, of course. And then whenever you want to increase your rate, you have to go through the regulator. So the utility business will come with the natural playbook of, we are going to invest X billions for X years, and then to like maintain, improve the power grid, create new solutions. And then we're going to go see the regulator to ask for a rate increase, and then they're going to generate more money, more revenue from those investments. So it's a classic. If you've done like a bachelor degree in finance or like followed any finance course, you're just like Determining how much you're going to spend, that's your project value, how much is going to generate in cash flow once you increase the rate there. And then boom, very predictable, very stable. And this is one of like the most interesting thing about regulated utilities. So in terms of the narrative, what is the growth potential around CU? Well, of course, it revolves a lot around Alberta. So around Alberta, because we have like a strong economic environment there, we have population that is growing, we have a thriving commercial and oil and gas business as well. So Canadian utilities can make a lot of money simply by offering power in this province. They also invest into new projects. As I mentioned, it's part of the playbook. So their capital investment for the next 3 years, they plan to invest anything between 4.3 to 4.7 billions in the next 3 years. And they also intend to increase their rate, increase their earnings accordingly. So that's the whole plan. They invest, they increase like low mid-single digit, but then it should generate like higher earnings per share. And then with higher earnings per share, what comes with it? Well, usually increase of dividend. They also invest into new projects such as the Yellowhead Mainline project to serve north of Canada in a better way. Again, they're going to run the same playbook, like invest massively, ask regulators for a rate increase, and then make more money out of it. If you are looking for companies that have a long trail of consecutive dividend increases, but on top of that shows the ability to grow their revenue and grow their earnings, you can download the Moose Market Rockstar list. So you go on moosemarkets.com/rockstars and you can subscribe to the newsletter. You're going to receive the most updated list of rockstar companies. A rockstar company is quite simple, is a business that is actually, we use the DSR stock screener and we select all companies that are showing positive numbers for the 5 years, revenue growth, earnings growth, and dividend growth. The goal is to have a robust set of metrics to start looking into each of those companies to see if there's anything interesting out there. So great starting point to invest in the stock market. So moosemarkets.com/rockstars. So now let's go back to the numbers for Canadian utilities. Speaking of the dividend triangle, well, if you look at this one, it shows a weak dividend triangle. And by weak, I mean revenue and earnings per share aren't growing. They're actually stagnating, sometimes slowing down. So there's little growth around there. And this is being reflected into their dividend growth policy. Yes, there are 53 consecutive years, but there is also only a 5% increase in the past 5 years. And I'm not talking like 5% annualized growth rate. I'm talking 5% total. So 2.8 in 2020, 1% in 21, 0.9% in 22, 1.1 in 23, 0.9 in 24, 0.7 in 25. So definitely not on a growth streak, very, very barely just increasing their dividend just to say that they are still to this date the company that has the longest dividend growth streak. But there's nothing to be impressed about besides that long streak. That brings me to the risk section. So the risk section, well, by its business model, it is capital intensive. As I said, the playbook is you need to invest a lot of capital to raise your rate and make more money. So if you have to spend a lot of money and then you are wrong about your calculation because of inflation, because of higher interest charges or any like delays in your projects, well, then it becomes less profitable, it becomes a problem, and then your earnings per share is going to suffer. You're also limited because you cannot raise your rate as you wish. You need to go through the regulators, which sometimes it's great for predictable cash flow, but it's not that great if you want to grow fast. The company is also territory captive. Most of its business and its growth potential comes from Alberta. So when the province goes well, everything is fun, but if Alberta runs into recession, then we're going to have a big problem. Speaking of which, well, recession possibility in Canada, the fact that we have like a lower immigration policy now, more restrictive, probably going to slow down the economy altogether. So it's going to be a little bit tougher for this type of business, such as Canadian Utilities, to report growth. So is it in danger? No, but those are the risks that you have to deal with if you invest in CU. So what's the role in CU in your portfolio? Well, definitely a role of stability. If you want to go for this one, you buy it for the yield and you see it as a deluxe bond. Deluxe bond in a sense that do not expect much from the stock price because it's not going to move. Like the price in 2015 of Canadian Utilities was about $40, and what it is today, well, 34. So no growth in 10 years for the stock price, where the stock market like skyrocketed. So you got the dividend, you got a small increase altogether, and this is why I call it a deluxe bond. So you get a little bit more than a bond because the bond, the yield will be stable, and you hope for some stock price increase. Sometimes it could happen, but just to keep in mind, it's not going to be a growth company. Actually, the low dividend increases are making me putting this one aside and not wanting me to buy it. So would I buy it, this one, even for stability? No, I think there are like better opportunities. If you use the stock comparison tool at DSR, you can easily compare Canadian Utilities in the regulated assets. You're going to find companies with a much stronger dividend growth triangle, and it's going to help you make better choices. So that's it for today. You can go on YouTube to leave me some comments about Canadian Utilities, what you think of it. If there are any other companies that you would like me to review from time to time, I select one and I'm having some good fun to review it. So Canadian Utilities, a good deluxe bond, but monitor this one closely for future dividend increases. We're starting to get very dry on this one. So you buy it for the yield, and that's about it. All right, Moose, that's enough for today. We're going to talk again tomorrow. And until then, don't forget to stay invested.
Hey, welcome to the disclaimer. If you're listening to the Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy this show and do your due diligence after it.